Now let's talk about liquidity. This is the juiciness that the market maker hunts for. In a nutshell, market liquidity is a market's feature whereby an individual or firm can quickly purchase or sell an asset without causing a drastic change in the asset's price. Liquidity involves the trade-off between the price at which an asset can be sold and how quickly it can be sold. So when it comes to liquidity for the purpose of what we're doing, we need to understand that there is a liquidity provider and then there is liquidity. So let's go through the process of how assets get to an exchange in order for us to trade with them. So step one, a new coin is created, usually by a genius who thinks that they're creating the next ETH killer. Market maker comes to know of this new coin and approaches the creators saying they want to invest. The creators get all excited and sell them a bunch of coins for either dirt cheap or they give them a lot more than what they actually paid for. But the market maker isn't investing because they think this is actually the next ETH killer. They know they will be able to offload this onto retail at a higher price down the track. So now the market maker goes on his mission, or her mission, to offer these new coins to exchanges. They lend the coins in exchange for profiting off the spread of traders buying and selling the coins, and the exchange makes their profit from the transaction fees. So it's a win-win. And this process is called providing liquidity. Now the exchange lists the coins and retail start to trade back and forth. The retail enters stop losses to protect themselves, or if they're taking trades on leverage, which is essentially just a contract of the asset, not the asset itself, they are also given a liquidation point. These two are the liquidity. So the market maker is the liquidity provider and retail are the liquidity, to put it simply. The process gets quite complicated, but essentially, whilst price is moving up, the market maker is selling it to you spot while also building their leverage short positions. This is how they remain delta neutral and protect themselves from having too much risk. Liquidity, as it relates to trading, is referring to the buy and sell orders. Now, buy and sell orders can come in the form of limit order entries. It can be a stop loss entry. It can be take profits and liquidation levels. All of these things are buy or sell orders in some way. Now that we know for every buyer, there has to be a seller and vice versa. So let me present to you with a scenario. Let's say price is coming from an uptrend and moves into consolidation, and that consolidation creates a pattern called an ascending triangle. Now, retail traders are taught that in an ascending triangle, it's a continuation pattern, which means if price came from an uptrend here, and then it goes into that triangle, then we should expect that price is going to break out next to the upside because it's a continuation. So if all retail traders are taught the same thing, and we know that for every buyer there must be a seller, then who on earth would sell the breakout of that triangle? Somebody has to, otherwise the price can't move. Cue the market maker. The market maker has to take the opposite side of your position. So whilst you are opening long trades, the market maker is opening short positions against you. But well before this happens, they had jammed you up in consolidation during what we know here in this method as the W or M formation, also covered in the one formation video. And that extended period where the M or W was being created was the time that the market maker worked their hardest to jam traders into a position in the wrong direction. Because don't forget, traders will short when the price is already going down, and they will long when the price is already going up. So at level 3, there will be plenty of FOMO traders who think the move is never going to end, and they will open a position at the exact worst time. Once that position is opened, the market maker now has liquidity in the form of your stop loss or your liquidation level. Now that they've got you committing to the wrong side of the trade, they have built all of their positions in one direction. They let price fly, retail then jumps on board, because the move has already happened and they're now in the new trend. The market maker is now opening their positions in the opposite direction whilst taking profits on the positions that they built during the M or W, and this allows them to get through the 3 rises. And all the while, the short traders that they trapped at the bottom before reversing price are now getting liquidated as price keeps going up, and those liquidations become the market maker's profit. I'm going to conclude this lesson by saying this. It's not that people who trade retail patterns are going to lose all of the time. Some people can make a real living out of trading retail patterns, but those people are few and far between. And for people who do get to that level, they're not the market maker's target. The market maker's target is the amateur retail trader who they know haven't dealt with their emotions, and they know by doing certain things on a chart, they can convince you to commit to a position. But the problem is every retail trader who doesn't think about who their opponent is going to have to go through all those years of tough lessons before they even have a chance of becoming someone who doesn't fall victim to the market maker's games. Know that for the most part, most patterns will play out during level 1 and level 2, but they don't play out at level 3 because that's where the market maker is issuing the reversal. And the problem with retail trading is most traders are happy with a sometimes works out strategy. But if you understand where you are in the market maker's business model, then you can still trade those patterns, but avoid them at level 3. And in an instant, you have gone from sometimes patterns that play out to knowing when to avoid it. And this alone will increase your win rate. So that being said, many stop hunts are issued just outside of retail patterns, no matter what level we are in the cycle, because stop hunts, as you now know, are how the market maker builds their positions. So if you've ever said to yourself, damn it, I got stopped out and then the trade went my way, well, the market maker knows where most retail will take their trades and put their stop losses. So by learning the market maker business model, you will understand where a stop hunt is likely to appear, and you can wait for it to happen before you take your entry. Again, this leads to a higher win rate. And all of this is why, if you want to play in the financial markets, you must know who your opponent is.